All right. Welcome to today's workshop. Going to be joined by Richard Bailey in just a moment. I'm going to give a bit of time for people to arrive and get settled in. So as you're arriving, you should be able to type into the chat. Just a give me like where it is in the world that you're currently based. So Richard is at our London office, and I'm coming to you live from Cape Town in South Africa. And I see we've got Thomas from Ireland. And I see we've got people joining us. So let me know in the chat, where in the world are you currently based? And while you're doing that, I'll just note that today we will be talking about how the Axia trade has reacted to the recent Iran missile attack on Israel, and that the volatility that's created in the market. And potentially we'll hear from Richard what else maybe we're expecting and some of the developments around that, but then also hearing about order flow and scalping tactics and what traders in our team do to prepare for these volatile events, how they respond to them, and how to use Jigsaw's trading tools to analyze your performance and improve as a trader. So today's session is going to be jam-packed. I see we've got quite a people tuning in from all over. So we've got from Nebraska to Portugal, in Madeira, we've got Croatia, New Jersey, Netherlands, Senegal, Luxembourg, Utah, Philadelphia, Nico in Germany, some London friends, Czech Republic, Quebec, Lauderdale, Scotland, Morocco, just all over. It looks like a lot of European traders joining us today. We've got a few US viewers from Texas, Southwest UK, Spain. Awesome to have you guys joining in. So glad you can make it. So today's session, as I said, with Richard, we're going to be kicking off right about now. Just take a moment to read this disclaimer. This just notes that it's not financial advice. This is for educational purposes. So just covering that basis. Anthony from Barbados. A bit of a tongue twister there for me, but we got Toronto, California. Awesome to have you joining. So today's session, you're going to see how traders in the Axia team reacted to the Iran attack with scalping and order flow tactics that we'll speak about, what professional traders in our team do during volatile events, how to spot the best markets to be trading, and how Axia traders find scalping opportunities during these type of events. You're also going to hear about how to use Jigsaw's tools to improve your own trading and best practices to enhance your trading skills. And a lot of this isn't just theory. This is stuff that is actionable based on insights that you can apply based on what traders in our floors in London are doing right now in today's markets, our floors in Poland, as well as in Cyprus. And to take us through this, we've got none other than Richard Bailey, our head of training here at Axia Futures. He's responsible for developing a lot of the strategies that are taught to our traders and helps develop some of the thinking behind that. And he's helped mentor many traders from junior all the way up to elite level. So he really knows what it takes to build a successful career. So without further ado, I'm going to welcome Richard to the call to kick off today's learning session. So Richard, are you there to walk us through?
Yes, I am. So I clicked go on the video and it didn't immediately pop up. So that's why I had a slightly surprised tone in my voice there. Thanks
Nice.
for the intro though, Craig.
Very cool. Over to
Yeah,
you.
see you in a minute. Right, let's get on with it then. I'll share my screen and we can start. Here we go. Right. There we go. Hopefully everyone should be able to see this. Now, as Craig did allude to in the intro, we're going to be covering a little bit of the Iran ballistic missile threat and how to go about trading it. And one of the things I really want to try and emphasize here is the considerations that go into these trades of not just which market you're going to trade. And there's obvious places. I'm sure everyone's thinking, well, this is an oil trade, right? Yes, it is an oil trade, but there are other options. What are those other options? Why those other options? And also, how do you play them? Because when they're not the direct market to trade, it then becomes a question of, well, that you're going to have a slightly different approach. And these very much feed into the kind of more sort of scalp type of approach. But before we do that, this was the top trade of last month. So I'll give you a little bit around where performance was over the past sort of month. So starting from the beginning of September. Now, the end of September, early October was a fantastic time for trading. There were three very big opportunities that effectively came one day after another, with the exception of 28th, 29th of September, which were obviously the weekend. So weekend, you got a little bit of trade on Sunday night, but we had three very distinct opportunities. We had the Japanese elections. We then had the hawkish Powell comments that came out on the first of the, or not the first of the month, the last day of the month, the first day of that week on the 30th. And then you had the Iran missile threat as well. And what's really important, the reason for pointing these out is, oh, we've got no visual. No, I'm hoping everybody else can see. The reason for pointing this out is to emphasize the fact that you don't know where your performance is actually going to be coming from. In the sense that, you know, when you're looking at any kind of month's performance, you can have a reasonably flat month that is made good on the last day. You can have a very good month that is made good on the first day. And it's this ability to go, okay, this is a big deal today. This is where I'm going to make my money. And it's understanding that kind of concept. Yeah, people talk about consistency, and if you've seen me do other things, I often talk about consistency and the way that it's misinterpreted. Consistency should be seen as a longer term thing. Yeah, your performance over a month by month by month, rather than day by day by day. Day by day is going to be up and down. You see that quite noticeably towards the middles of the month here. Yeah, no one day really stands out. There's up and down performance. Incidentally, the gray is your final P&L. The blue is the peak. Red is the trough or the biggest drawdown on the day. So that gives you that sort of perspective. Really helpful for you to see when you're going back and analyzing your performance. How far down can you go and be able to pull it back? Is a really useful kind of metric to look at. Because this is what I call a cliff edge. We could do a whole different session on this, on risk management and what I call a cliff edge. Most people have it, where you get to a certain point down and it doesn't matter what you do, you will not come back from that. Even if that's not your stop out for the day, you won't come back. So knowing where that point is helpful. That you're almost not worth going beyond, let's say here, because if you go beyond here, even if you could afford to go to here, you're never going to get it back anyway. So you're only really risking the chance of a full stop as opposed to actually getting any kind of a recovery on it. So it's always worth looking at your performance in that respect. So there's the top three. And this really sort of shows up when you consider this as a P&L for the month, where you really see the big jumps. P&L is more than doubled. In fact, it is nearly quadrupled in 3 days. And that's the significance. And that's what it's not consistent per se, but it's being able to do that and perform on these periods, which is what gives you this consistent sort of month on month performance. So there we go. There's your big jumps, but we're going to go and look at the biggest of them all. Now, I said about not trading just oil. Oil is the obvious place to go, but if you look at the top markets on this day, we've got Brent and you've got WTI. Now, different people will trade different ones of these for various reasons. Predominantly, it comes down to the one that you're more comfortable in or the one that you're more used to trading. Yes, Brent is more directly impacted by anything in the Middle East, but WTI will move in correlation with it anyway. So I'm not going to get into the precise distinctions between the two. But those two are the bigger performances. And if you combine the two, that's by far the biggest performance. But there's also the consideration for other markets. The actual top performing individual market on the day was Bund, and the third best S&P. Now, yes, it's reasonably obvious this is a risk off type of play. But what's significant about this and why you need to focus on these is to consider the ease with which you can enter. Very, very directly impacted markets can often be harder to trade because everyone in the world is trying to get into that. The obvious place to go in a situation like this is oil. So if you're rushing towards oil, so's everybody else, and you've got to compete with all of those people. One thing that I do always point out, and this is not so much something to judge your performance by, but something to look at your performance and go, okay, that's okay. And that is distribution of winners and losers. So this is among a group of our traders, predominantly London traders, and you've got a 40% win rate, despite the fact that this is a huge day. And this is the important bit. It doesn't matter if you lose 60%, right, 57% to scratch 3% of your trades, if your top four markets are miles and miles and miles bigger, 10, in fact, 10, 15 times bigger, your biggest losing market. That's where it matters. So win rate doesn't. It's about scaling and maximizing opportunities when you get them. Right. Let's go and have a little look at this. And what I'll do is I'll walk you through why you would look at different markets and also your approach to them as well. So we'll look at an hourly and a 1 minute, and then we'll go and actually have a look at the way this plays out as well, the execution side of things. But something that I think is often forgotten or not emphasized enough is no matter how macro someone is and how news orientated any individual trader is, ultimately they've still got to be a good technician. And so if we go and look at oil, you want to split up your movement into phases. Now, your first trade here, yes, you can look at this and go, oh, wow, look at the size of that move. But in fact, the move actually starts at around about 71. So it starts off here. Now, your first trade, ultimately, your target's going to be here. That's the highs from the previous day. It's the lows before the breakdown last week as well. That's the place that you want to be looking for. So it's about being able to give yourself a clear short-term target and then the potential for the larger target. Now, of course, oil is the most directly impacted. So this would immediately be the market that you're thinking, yes, I can play this for a second leg. But it's about the understanding of how these things play out. So we go and then look at it on a shorter time frame. Your initial target is this sort of 69.24. It's actually, if you consider this high here, 69.10 to 24 area. You go and look at it on a 1 minute. This is then what happens. This is the first move, the action, where the news comes out. This is where the most volume is, the most pace, the most people participating. That does that move up towards the target, the pink box, in about 5 minutes. The next leg, the direct, this is the most important market move, takes at least another half an hour and more if you're going to go all the way for the big next leg. This whole chart only shows you for the hour and a half after the action, and oil in fact then continued another dollar towards the upside from here. So you've got to sort of compartmentalize. Are you playing for the what I would call a sort of scalp trade? This is your point to point in, target out, leave it alone, and then play a continuation? Or are you playing for the big one, in which case you'd be willing to sit through this rush up, deep pullback, and continuation type of play? So it depends on the way that you want to try and approach this. And you have to have this thought out very quickly when you enter, or ideally more once you've got before you even take the trade on. And in this situation, the narrative was clear. We knew what was going on. Yes, you didn't know that Iran was going to threaten a ballistic missile attack. But what you did know is that tensions were high, and anything that escalated this was always going to be a positive for oil. So you could already have this plan in place. Next up, S&P. The reason you go S&P is risk off. If uncertainty builds up, the obvious place to go is equities, selling equities, that is. So people exit equity positions in times of uncertainty. The S&P was quite nicely set for this, particularly from the perspective that having attempted to get out of this lower range above 5,800, there was the scope that if we fell back in, you could then go and retrace back the move that you got on Powell and Lagarde, which was this move up from 57.55. But the important thing here in the short term, and this is where you've got to make sure you're watching the oil. In the short term, you've also got these lows around 75, lows around 70. So I'm always looking at the sort of hurdles on the way. So you got 75, 70, you've then got 55, and then beyond that, you've got 45 and 34 could be your big targets on this. So again, it comes down to how are you trying to play this? Are you trying to play it for the first move, or are you trying to play it for the full move, if you will? And this is then what you get. Very similar, but whilst oil does that very big 150 tick move, the S&P is somewhat smaller. This is only, I say only, this is only about 25 handles. You break the overnight low, and then you get that move down into this sort of 75 to 70 box. What was nice about this, and there were a few traders that were actually already short, not because they're predicting anything or guessing anything, but once you then broke this overnight low, which was down here around 99, people then started to get in. In fact, sorry, it's not there. The overnight low is around here. So people are selling it as you get through that overnight low, looking for this move anyway. This is where luck comes in. Sometimes you're on the right side of these things. And if you are, you've now got the chance to add on to the trade. And you can then also expect, and this is the great thing about news, you can now expect it to reach that target far quicker. So your target's there to be had. You've just been given that little kick to say, yep, you're right. Stay in the trade. Let it go towards target. Yes, again, your bigger target is going to be down in this sort of 55 area and then 34 area towards the downside. Sorry, those are your 34s. That's your big target. But again, it comes down to this ability to kind of structure your idea. Okay, well, first move, once oil starts to stall, you're going to always get a stall in the S&P because effectively the S&P is tracking what oil does, obviously the opposite direction. And then finally, Bund. This is your less obvious market. German government bonds. It's a little bit of a step away from the obvious. And what's good about this is you're escaping the competition. Less people are going to hit the Bund than are going to try and rush into S&P or rush into oil or any of those types of markets, gold even. So this then is your market to go, okay, I can get my size on here. There's always got to be a decision in terms of comfort. If you've never traded the Bund before, then you don't go rushing towards the Bund, and maybe you trade T-notes or a different market. But the idea being that if you understand a market and it's presenting you with less competition, yes, this goes nowhere near as far. The Bund was already trading up here when the news comes out at about 35.80 and trades up about 50 or so ticks. So it's not a gigantic move. Sorry, 35.80, 35.90. Sorry, trades up about 40 or so ticks. It's not a gigantic move, but this is the one that you can get the size on. Technically as well, Bund was very strong. This move was already done. So you're buying a very strong market. The thing to have considered here, and this is why I always emphasize technical structure and understanding what's going on the day. Because we were so strong anyway, you had the possibility of it being exactly what Tim said, extremely stretched. So this is one where your plan is going to be a little bit more willing to get out quickly rather than try and stay in. Because if you try and hold on in an already stretched market, you run the risk that the people who are long from, say, down here are going to start profit taking. So not only is the Bund arguably the least related to the story, it's also very stretched. So yes, it can go up on it, and as a risk-off trade, bonds should rally, but don't expect it to stay up. And it's exactly what you then get. Yes, Bund move, up we go. Excuse me, up we go, sits up at these highs. And so whilst the S&P oil from here continued on to the upside, S&P continued to drop. the Bund gave it up. And we all know, well, if you've watched any kind of bond markets since the beginning of the month, they have not just come back off this, they have absolutely collapsed. Bund, by the end of the week here, was trading down here. Huge move. Now, I don't think that has anything to do with Iran. That is much more to do with the broad inflation rates sentiment in markets to sort of follow on from how the previous day. So we're going to go and have a little look. What I'll do is at times I'll flick through the charts. So I'll leave all the charts back up as we go and have a little look at how exactly you go about executing this. It's all very easy to go, look how it moved. But we're going to go and have a little look at the execution of it. So about 5 minutes. And what I'm going to touch on is particularly that initial move. And this is the bit where your mentality has to be around, what are my targets? Where am I trying to get to on this type of trade? So let's go for it. I'll try and point out different things as we go along. So this is then the point where you're looking to get short S&P going through that overnight low. So any of this sort of key information should appear up at the top. So playing the S&P short through that overnight low. So a nice sort of situation to be in. You will notice when the news hits. S&P drops, oil jumps, Bund, it didn't move much, but it was instantly up 3 ticks. And this is what I mean about having the chance to get in. The S&P put in a very quick move. Oil jumped about 30 ticks plus. The Bund moved 3. You've now got the opportunity, and you saw the liquidity stayed in the Bund. Bund's on the right instantly. This meant that you could get into this and you could get as much size on as you want, whereas the others, you're always chasing. Bund, you'd already got the highs in play anyway. So you knew where the high was on the day. So we'd already been up there within that hourly candle beforehand. So you get your targets in with a Bund. Remember, this is a market that you already believe has the potential for exhaustion in it. So you get your targets in on the Bund. That's the first one to deal with. You can leave that now and focus on the S&P. So the S&P, not the S&P, sorry, oil. With oil, what we've done is we've jumped up to just below the previous day's, just below the morning's lows. So you're in this area here. This is where you've got this little kind of sticking point between the lows from the bounce back after the morning drop and then the morning highs. So in this zone, you're quite happy to then go, okay, well, I'm either going to be trying to buy a pullback towards 00, where the volume's building up on the ladder, or you're going to try and buy on the breakout above 25, which is what's just happened there, adding on above that 25 area. So now it's a case, right? Oil's in play now. We're into this area here. Expectations, we're going up here. When it comes down to S&P, we're now in on the break through those overnight lows. Apologies, we've lost the ladders. There we go. You're on the break through those overnight lows, and you're looking then down towards this first sort of target area initially. If oil goes and goes and goes, and this is what you've always got to consider as well, if oil just blasts through the 69.24, stay in the S&P, look for that bigger straight line move. But if it doesn't, this is where you might be a little bit more keen to sort of scale it back at that point in time. The Bund, you're looking for this move up through towards the 20 area. So get your targets in, just trying to scale out of this one. And once you start seeing it sticking up at that area, that's where you want to start to give this one up. Oil at this point is giving you a bit of a pullback. We've dropped back towards sort of 68.50. So all the time, what I'm doing is I'm constantly sort of thinking, right, where is the limit of any kind of drop? And you can now start to kind of step back. The actions happened in terms of the initial movement, the rush to get in. Now it's a case going, right, what are my targets? Where am I going to give this one up? Like I said, oil just dropped back to around about 50. Which was within this move here. The S&P at the same time has dropped. It's not really pulling, it's not really bouncing back. And so the S&P, you're then still thinking, right, use this low volume, get your stops in up here. and let it go. Let it go and do that move. So you now starting to see there's your 15s in oil. There's your 24s traded in oil as well. You're into this zone. This is where you then try and take your profit on this one. Scale the position back. What you're interested in here is then what happens next. The fact that oil has blasted through 69.24, the fact that it is still on the way up. Yes, it's a bit of an exhaustion spike. It's a bit of a rush. On that spike, you give up on Bund because Bund was the market that you were least expecting the big continuation in. So you can give up on the Bund, out of the Bund. As oil then starts to pull back and it drops back below the 69.25 area, this is then the point where you give up on the S&P as well. And then it becomes not going to sort of continue onwards and onwards because it would be a long time through. But this is then the point where, as I'd put in the little graphic, you need then to consider where exactly your stop's going to be and what exactly you're going to do with this trade now. Now, remember the point that I'd made that oil is the one that's got the biggest scope, right? So if oil's got the big scope to move, then you're okay to let this one pull back. It feels horrible. Don't get me wrong. When you've just seen it trade in 69.50 and it's now trading 68.70 or 68.80, that feels like a big pullback. But you have to remember, this is the direct impacted market. This has got more in it. You've just banked a fair bit in Bund, 25 ticks in Bund. You've just taken 25, 30 handles out of the S&P. This is where you can say, okay, I can accept a 70 tick pullback in oil. Get your stop in, because at the moment, looking at this, you're playing for another 100, possibly 200 ticks on this move. So sitting through that pullback is entirely doable. I know people often sort of look at it, oh no, but I don't want to lose. I had this much and now it's pulling back on me. Think about the big picture. That's why you need to be a decent technical trader, why you need to have understood the structure of where you can go on this one. Yeah, up towards 69.80, up towards $71, so that when you get the little pullback, because that little pullback is to here within this move, it trades here and it pulls back like that. Now, that doesn't look much on an hourly when that's your next move, but in the moment it does. And that's what you have to kind of remember. Think about the bigger picture. So it's not just all about trading news and just smashing the story. It's about understanding the technicals and also the fundamental side of the significance of this move and which market's going to be best and most affected by it. So there we have it. Open to questions. Get any questions in about the execution of the trade, about any of the tools, why you would use them, how you would use them. Happy to answer questions for a few minutes, and then we can let everybody get on their way.
Cool. Thank you, Richard. Also, something I will note is that next week we're going to be running another workshop similar to this. If you want to register for that, I'm going to drop the link in the chat. I'll also just share my screen for a bit so you can see it's axiafutures.com/workshop. So we'll be running a workshop. I think Alex we're still deciding what the topic is going to be exactly for that, but it's either going to be something on the market environment, something on order flow, and definitely touching on stuff that's relevant to today's market. So if you want to sign up for that, if you got some value out of today's session, definitely grab a seat for axiafutures.com/workshop, and that'll take you to the Zoom registration page. So, but yeah, as Richard said, if you have questions, pop them into where's the best place, Richard? Should we ask people to put them into the Q&A area or the chat area?
I think probably best stick your questions in
Q&A area.
Yeah, probably Q&A is best. What I'll do, I will read them out before I answer them so that everybody who can't see it can see it. Appreciate those that are already in the chat we'll answer those as well. First question I saw was on news source. Incidentally, I'll be appearing as well next week on that workshop with Alex. What's the best news source? Is Twitter reliable, and what channels? I think this depends on what you're looking for, right? So if you're looking at data, then generally you're not going to be able to beat the mainstream news sources, so Bloomberg or Reuters. But with a story like this, the people on the ground are the best people to talk about it. The people who've heard this through the grapevine. And yes, you always have to accept that there is an element of fake news, to use a current terminology. But Twitter's a fantastic source of information, particularly for sort of Middle East oil-based stories. Twitter is fantastic. My top person on Twitter for news is a lady called Amina Bakr, AMENA BAKR. That's my top tip there on Twitter for this type of stuff.
Nice.
Twitter's very good broadly for news. Yes, that trade was done on replay. It was done to sort of illustrate the way to go about it. Unfortunately, we didn't have anyone who's actually recorded that one, but as you saw from the performance, top day. Replay is a fantastic tool. It's something I wish I had when I started, because it really gives you the chance to go and hone your skills. So if anyone does have the facility to replay stuff, do it. It's something that I emphasize a lot on any training that I do with anybody here. The course we run, get people a replay, get them to retrade event specific things, learn the flow, because there's nothing like seeing the flow on those types of things. If you've never seen it before, you're going to freeze in situations like that. If you see it via replay, you're going to know what to do. Right, I'll cover the ones in the chat and then I'll come back to Thomas's. So I haven't forgotten you, Thomas. How do you approach the market when an edge degrades or stops working, volume drops, conditions change, you start taking a lot of stops? That is something that's always going to happen, right? Environments change, market shifts. We've seen a lot of this year. And part of it is, I talked about this whole idea of sort of viewing performance over a longer period of time. Part of it is about being able to step back and say to yourself, okay, things are not going great at the moment. What you need to do, pull your size back a little bit. Focus down on the things that you know you can do well, the things that you can control. And this is where consistency matters. It's your consistency of approach, your consistency of routine, of debriefing. That's what gets you through those. Now, don't get me wrong. I'm not saying that you're going to suddenly be able to start making money in these periods. Often it's a case of just being able to sort of tick along, tread water. When the opportunities come back, if you've not put yourself in a bad position because you've recognized the shift, and in trying to adapt and learn new environment, you're able then to make the most of when things come back, the new environment that you've learned, you're now able to trade that again in future. We've seen this year. 2024 has been a tough year for traders, and it's one that has been basically a year that people have done a fair bit of treading water early on, and have now the performance has really come through since August, simply because of things that are happening that are bringing back some of that volatility. Don't get me wrong, people were able to perform earlier on in the year, but it wasn't standout. This is where you really get paid. Any methods of staying calm in these trades? Great tip on this is, once you're in, one of the best ways is to understand the scope of the move, right? Pick your targets off an hourly chart. Don't pick your targets off a 1 minute, because if you pick them off a 1 minute, they'll probably be too close and you'll get out. And then this is where your mindset goes. You're then watching it continue and thinking, oh no, I should still be in. And then you're chasing a move. You don't want that. Pick your targets off an hourly. Look at your hourly chart. Pick your targets, sit back and ask yourself, is there any reason that I'm wrong in this position? And yes, it might be jumping around, That doesn't make you wrong. It means that the journey to the target is perhaps not a straight line as you hoped, but it doesn't make you wrong. That's one thing to remember. Another good tip on this, once you're in and you've defined where you're going, watch a 1 minute chart. It takes you away from the jerkiness, from the sort of panickiness of the ladder. Ladder's fantastic for getting in, but once you're on the road, give yourself a chance just to take a step back. Even if you say, right, I'm going to watch this to the end of the candle, or I'm going to watch this for 30 seconds whilst the market settles itself down. If it starts ripping back against you, you'll see it on the chart anyway. So you can then go, okay, well, now I can step back and sort of chill out effectively. Can I show day trader platform explanations of some of the most important concepts? I can show you. I'll bring the ladders back up from what I had. In terms of important concepts, so this is, yeah, I'm going to take this to mean more to do with how to read a price ladder. Key thing that you're interested in, right? I'm assuming people understand that these are all the people placing bids in the market. So all the people wanting to buy, waiting to buy. These are all the people waiting to sell. What I'm really interested in, and this is to give a really, really brief explanation of
Richard,
price.
are you showing your screen right now?
Aha. If I share my screen, this will be a lot easier for people to understand. Give me just a moment. Thank you, Greg. And
Cool.
where is... There we go. There we go. Right. So here we go. I'll focus on the Bund because it's a little bit slower than the rest of them. Right. So these are all the people waiting to buy. These are all the people waiting to sell, and the prices that they're waiting at. Doesn't mean that they're going to get filled, as you would say. What I'm really interested in, so to give a real quick summary of key concept, the thing that I'm most interested in is this number over here. I don't personally like the idea of lots and lots and lots of information, which is why I simplify ladders down. Good idea if you're starting out looking at a price ladder, simplify it down. The key things you need is the price, the bids, the offers, and the last traded quantity. If you feel you need more, add more afterwards, but you're better off to start with less and add than you are to start with more and subtract, because it's hard to know what to subtract. The thing that I'm really interested in is this number, the speed with which it changes, and the direction with which it moves. So if you're seeing consistently it's trading into the offer moves out the way, the bid moves up, and then it trades straight away into the offer again and again and again and again, that's a really strong sign of buying. Likewise, if you see the same selling. So that's the first sort of key bit. The other bit of information that I'm interested in, and the what I call passive orders, the limit bids and offers here. These people are people waiting. The only time that these are going to be really significant is if they start to change quite often, changing frequently. Look at oil, the way they're constantly changing. This is a sign of effectively sort of agitation in the market. People are urgent to do something. People need to do something. So when the passive orders are moving a lot, this suggests, well, people need to get on with it. You can see here a larger order in the Bund as well. But now you're starting to see that sort of clear push. Every time it moves up, trades the next price, trades the next price, trades the next price. Now you're starting to see it get stuck. When it gets stuck, that's your sign of absorption. So I hope that sort of covered a few of the sort of key concepts there. It's hard to cover too much in one, but I'm hoping that that sort of covered some of that. Right. Let me pause this one for you. Okay, I'm going to cover the ones that have come up in the questions now. Right, at what point of the developing story like this are you too late to try and enter the trade? I think it's always a case that I think after about a minute, you're past the initial action phase. You've then got to step back and go, right, I need to look at the wider structure. So I don't think you're too late necessarily. It's more a case of you're too late to be on that first rush. You're better off to kind of step back and go, okay, let's just work out where the market really wants to go here. Look for your pullback trades. So it becomes more structured. What are you expecting for this move? I mean, you're expecting for something to happen like an Iran attack in Israel, and you prepared the area of interest depending upon what would happen. How do you do that? Well, this is about thinking in narrative. It's something we do a whole week on during the 6-week course. Thinking in narrative is about going, right, this is the situation. We know what's going on in the Middle East broadly. So ultimately, this has a binary outcome. The situation escalates and gets worse because of some kind of attack, escalation, invasion, whatever it is. You don't need to know precisely, but you need to know that anything that escalates the situation is effectively bad news, risk off. Alternatively, you get a ceasefire and a de-escalation. That's the binary scenario. So anything that moves you closer to one or the other, you know what to do. Now, Iran suggesting that they will attack Israel is a more significant escalation. So the scale of escalation is bigger. But whoever this was that had done this, the same result would be the case. It's the scale of the move that differs. So you can plan it out because you're looking at a sort of broad categorization of scenarios. Some are good, some are bad. And it's then just the degree of how good or bad they are that is tradable. How can I figure out the direction when the open happens? And should I play both ways at the beginning of it? On the open, so I'm assuming you're talking about cash open. You can't know the direction of the market. There are some very specific open plays, which is beyond the remit of what we're covering today. But it's a case of ultimately you can't. I have a few open plays, but on the whole, I would suggest to trade straight on the open happens less than 20% of the time to have something that I could confidently say I know where it's going. What I definitely do not want to do is to try and do both, to maybe go long, maybe go short. Because if you do that, all you're going to do is get yourself trapped in a chop. During the oil pullback, would you keep the same size or scalp the spike and reversal while keeping a core long position? My approach on something like that is hit the first bit, have your target 69.25, scale back. I've always been someone who's more a sort of scalp type trader. So I would hit it, scale back, and then the view is I'm going to sit with a smaller position, either to buy on a pullback at a level that I feel is adequate to buy, or to buy through that high. That would be my approach to it. Lots of people have different approaches, but broadly the idea that you've suggested, where you scale down the initial position and then hold a core position for the big move, is the approach that most people take. The precise way that everyone does it slightly varies. Like I said, my approach has always been in scale 75% of your position, in if you can on a pullback, alternatively in on the break of that initial high.
Just want to note that if you were having trouble registering for next week's workshop, going to axiafutures.com/workshop, if it was asking you to create a Zoom account and you don't have one, I've just updated that so you will be able to register now without having a Zoom account. So just, I know Vincent encountered that issue. So if anyone else had that issue, you can go ahead and register now and you won't need a Zoom account. So yeah.
Excellent. Good stuff. Right, a couple of quick ones here. Do you regularly look at footprints, see the details of during the move? Yes, to a degree. What I'm going to be looking at, I'm mainly focused on the ladder. Footprint's going to be really helpful on pullbacks to see where you've got imbalances. So it helps define pullbacks. That's the main use of footprint for me on these. Any thoughts on updated content for footprint and price ladder courses? Glad you asked. We always try and update them reasonably regularly. No current schedule on an update, but we did do a very big update. In fact, I did the very big update at the beginning of the year. So they have been significantly updated in the last 9 months. Dan, I know you previously said you're not a big fan of the DAX, but could you give me some clues towards DOM Edge or any other tidbits I should be looking for in the DAX? I think with reading a ladder, it doesn't change whether you're in the DAX or the Bund or the S&P, Tino, oil, gold, whatever it is. For me, one of the best things you can do if you want to get better at trading a price ladder, well, 2 things. One, turn all your charts off and trade with no charts for a week and draw them. 2, excuse me. 2, go for a week and go, right, these are my levels, resistances, supports. And you say to yourself, I am going to buy at every level. So that implies you're going to play breakouts on all highs. You're going to try and buy all supports. What you're looking at then is the way the market trades at each of those points to understand what it looks like when it works and what it looks like when it doesn't. That would be the 2 best tips I would have in terms of learning order flow. Right, Ilias, what's your advice for a person who always gets a good start to the day with positive P&L, but at the end of the day, I found myself negative? Very simple here. Go and work out what it is that's making you money and what it is that's losing you money, because it's not just to do with you started well and you lost. If you start well every single day, I would suggest you want to work out what time of the day it is that you start to fall back. And at that point, stop. Or list out the trades that you lose money on. Work out what it is about those trades. Because if you can identify what you lose money doing, and there is a pattern in it, you can stop that really easy. That's pretty straightforward how I do that. Any advice on when a trade gives a lot more fake signals that fail versus ones that work? Not massively. It's not that trades are going to give that many fake signals. They either work or they don't. If a trade, I don't think it so much gives a fake signal as it is the signal is the signal. If a market goes up and then comes back, that's because it doesn't want to go up. The idea you've got to have the plan as to where you think it's going to go, and then you're looking at information that says yes, it's still going there. So a market doesn't give a fake signal. A market shows you what a market's doing. So look at it like that.
So there was a question about repeating some advice. I would say that the best way to get more advice and to learn more from Richard is to register for the upcoming workshop. So in that session, you're going to get a lot more insight into the stuff Richard's talking about, but there will be a replay that'll go out. So we'll send that through.
Indeed. For the question on English, I think we'll have subtitles on that, or you can probably get a subtitle on it. There you go.
Also, I just want to thank Jigsaw for putting this together and helping us schedule this event. So if you've come through the Jigsaw community, a big thank you for joining us today. And the tools that Richard you've been using, just to highlight, you've been using Journalytics, the day trader platform. So these are all Jigsaw tools that you should have at your disposal if you are a Jigsaw client. And we recommend using them. We use them on the career program. We train our traders on them. There
we go. Things to get testing out, I would suggest.
Yeah.
But I think we'll probably wrap it there. Like Craig said, get onto the workshop. There's a lot more to be coming on this as well. We'll be doing a fair bit of new stuff as well. So something we've not done before.
Awesome.
Excellent.
Cool.
Right.
Thanks, Richard. Thanks for joining us, guys.
No worries. Take care, guys.
See you. Cheers.